G'day. It's Scotty North from Zenium Live, and thanks for joining us today on Thursday afternoon at 3 o'clock. So grab a cuppa and a cookie, and I'll have a bit of a chat to you about what's been happening in the markets so far this year. All right, this is the first market update that we have done at Zenium Live this year. We've had a lot of guests on over the past, what are we doing now? 8 weeks of guests, and it's been pretty good. And if you missed any of them, you need to grab a listen either on their Real Property, Real Wealth podcast, or of course on our back catalogue on YouTube at Zenium. It's definitely worth having a listen to some of the great speakers we've had on. We had PJ talking about gold last week. We've had Steve Skeen on talking about goals. We had Ron Foley with aged care and development. And we've had the girls shows, so you need a whole bunch of catch up if you have missed all that. But today I want to talk about a couple of things in the market update. And we normally start our market updates with the HTW clock. And for those of you who don't know what the HTW clock is, well, it looks like this. So this is the National Property Clock for May for HTW. And HTW are an evaluation firm, so they're at the coalface of pricing and other bits and pieces, and they compile all their data from their valuations and put it into a nice round clock. Now I'll make that as big as I can for you. Here we go. All right. So this here is the ones in yellow that you can see on there are different from last month. Okay, now I've held off purposely. We were back at Zenium Live in March this year after our break and building the new studio and other bits and pieces. And I really held off coming back with data as we came right in when the Corona event happened. And I thought, well, there's a lot of people spruiking about data still at this time. And that data is out of date. I mean, data that we get in the property market is always, months behind. So not only is it compiled at the end of the month, it could be from data that's happened the month before or 2 months prior. So it can be anything up to 3 months late. So the March, April, and even May data is probably not that relevant, whereas, May, June, July data is actually going to show you what happened during the Corona event timeframe. So at the moment, we're starting to see some of that come on. This HTW clock is going to be telling you that everything in this yellow colour, which of course if you're listening on our podcast you can't see, is different from the month before. And those are Coffs Harbour, Illawarra, Newcastle, Perth, Sydney, Southern Highlands, Byron Bay, Lismore, Broome, Gold Coast and Southwest WA. Over there with Wodonga, Kalgoorlie, Toowoomba and Geraldton. They're all on the declining side of the clock. Down the bottom, we've got the bottom of the market. Now, Brisbane was at a start of recovery mode and it's gone back down the bottom of the market. So Brisbane's down there at the bottom with Alice Springs, Central Coast, Darwin, Ipswich, Southern Tablelands. Tablelands, it says. Nice spelling mistake there at HTW. And then we've got a start of recovery and a rising market. There's quite a few over there. Now, this is where it's very interesting to take. You've got to understand this is the data from HTW. So this is essentially what they're doing is they're taking their valuations and they're compiling that data and they're talking about how it relates to where they position it on their clock and the activity they see. So if they're seeing more data and prices increasing, well then the clock here is going to be telling them that and they put it in the right spot. If they're seeing that the sales are slowing and data is slowing the sales are slowing, the data is telling them that their prices are dropping, well then they'll move them around on the clock position somewhere else. So that's how that works. So let's go back to the clock here. We've got Devonport, Launceston, Emerald, Mildura, Gladstone, Hervey Bay, Hobart, Launceston, Mount Gambier. Man, they had the apprentices doing the clock this month. Rockhampton, Shepparton, Sunshine Coast, Cairns, Geelong, Mackay, Melbourne, Port Hedland, Townsville. They're all on the left-hand side of the clock, which is the start of recovery and rising market. They also say here approaching peak of the market is Adelaide, Adelaide Hills, Barossa Valley and Karratha. So they're approaching the peak of the market. So they're areas that you need to be wary of if you're looking at doing anything at this time in those areas. And of course, peak of the market is Albury, Dubbo, Bathurst, Bundaberg, Canberra, Tamworth, and Whitsundays. So I know, Whitsundays is tourism based. Bundaberg, a little bit. There's agriculture there and other bits and pieces. It's sort of the regional stuff sitting at peak of the market. It's a very interesting clock this month for those reasons. So that's the HTW clock. The next thing we're going to show you is something I picked up on from the Prime Minister's address yesterday at the National Press Club. So I was listening to that, as you do, and he said a couple of things about JobMaker. Now we're up to a JobMaker program. So that's pretty exciting, I guess, because we need jobs. There's simply no denying that. We absolutely need jobs. So we've got the JobKeeper, we've got the JobSeeker, now we've got JobMaker. So we're pretty good. I don't know what the next job thing is going to come, right? Like, who knows, mate? Who knows? So what I want to talk about there is that he made a comment about the net migration figures. And net migration figures are the figures of people, the number of people that come to Australia versus the number of people that have left Australia for good. Okay, so the number of people, if there's 10 people come and there's 5 people leave, then our net migration figure is 5. Okay, pretty straightforward. Thankfully, there's people with a lot more calculators and brain power than me to do those sums. But the interesting thing was that he said they have a net migration figure normally of 200,000 and above. And I've checked the figures and they've been 200, 230, 250, 270, up around those figures for the past few years. So that's the population increase from migration, not including births, but from migration. And that this document here that I'm showing you, which is out of government research in 2010, says that the net migration in Australia needs to be between 160,000 and 220,000 people. Okay, so that has been above that for most of the last few years. So we've had that. Now, if it is above that, it will have a positive impact on the growth rate of gross domestic product per capita. Okay, which also changes the speed of the population aging and a bunch of other things. So what they're saying is that the growth rate of gross domestic product per capita is hinging substantially, not on our birth rates, because they're already taken into account, but is into our net migration of sitting between 160 and 220,000. And when this report was done, it was 190 as an average, and it's been a little bit higher than that. So, with that in mind, in the Prime Minister's address yesterday, he said that they're forecasting next year, and they're not sort of forecasting subsequent years just yet, from the data I could see, it was 34,000. Okay, that's a massive drop down. We've gone from 200,000 to 34,000. Now, let's say that births stayed the same. Let's say that birth rates don't change. I mean, in general, in downward times, there can be a baby boom happening because people are out of work and there's other things for them to do. So that's what they do. But let's just say they stayed the same. Then we're down quite substantially. Now let's look at a couple other things before we do the sums, because we need to look at housing that relates to that. So I'm going to chuck this up here. Okay, so this website here is saying that in the year ending 30th of September 2019, Australia's population grew by 371,000 people. Okay, so 1.5%. So that's actually an issue as it stands, because the problem we've got at the moment is that Western societies, or societies in general, need a decent amount of population to growth to keep it, because there's births and deaths and other bits and pieces, and their whole figures are around birth rates per woman, child numbers per woman and stuff like that. It needs to sit at 2.1. and the fact that population needs to be in such a way of growing, because the whole thing is a growth model. Okay, the whole economy is a growth model. Whether that's right or wrong, that's just the data that's actually being presented now. So if we go here and we look at this population growth, we've seen that in 08 we peaked at about 2.2%. Yeah, 2.2% in population growth. And then it's been sort of went down to, 1.4, back up to 1.8, and cycling around that sort of amount there. And we're sitting at 1.5 end of last year. Now, that was 371 people. So let's just go to the calculator here. Let's see if I can do this while I'm here so you can see me. So let's just say we had normally 200,000 people coming in as our net migration figure, but we're not getting that now. Next year, we're only going to have 34,000. That's 166,000 people less that we're going to see, right? So if we go back over here, you go 371,000, right? So 371,000 minus 166. So we're looking at 200,000 population increase in the coming year. Now, why is that important? Well, that's probably sitting more, that's like a little bit below 1% of our total population. So I'm not going to go into whether that's good or bad or whatever. I mean, that's just what the stats. But here's what we need to look at in relation to what that is. We've got to look at construction. So if we're looking at construction, we need to look at this figure here. And we're going to tie it all together shortly, okay? So the average per person household, okay? So we're sitting between 2.6 and 2.7 people per household on average. So let's go 2.6, okay? Because that's going to use less people per house. And let's work out how many houses then. So if we then divide that by 2.6, we need 78,000, call it 79,000 houses. What do you want? Whatever you want to talk about. 79,000 new dwellings to accommodate those people moving forward, right? So let's see here. Construction industry forecast. So this was done before coronavirus event. I'll try and make it a little bit bigger for you so you can see. This is from the Fin Review, and it's saying that over the past 3 years, home starts will decline from 228,000 in 2019 to 176,000 in 2023. Now, of course, we're going to get more drop off than that with the whole corona thing that's been going on. But my question is, they're not slow things. Like, you can't be halfway through a house and generally stop it, right? Like, it has to be completed. So my point is, even if we took the lower number that was going to come on this year, and I couldn't really find the exact number of data that said how much of the completed stock was going to start, was going to finish, how much new stock was going to start, what was going on. But if we took that data of 176,000, that was the low figure as it declined into 2023, as the figure right now, because it was just stopped halfway through the year. Now, I could be wrong here, but let's work through this. Then what we're looking at is next year we need 78,000 homes, but we're assuming that it could be 170-ish thousand homes coming on. Even if we took that down to 130,000, right? We're still looking at a substantial number of houses there that have been created and yet aren't needed. Okay, so hopefully you followed what I've done there. What we're looking at is we're looking at the net migration plus the population increase that gave us a total population number around 200,000. We divided that by 2.6 people per household, which then gave us how many dwellings that we actually needed for the coming year, which was 78,000. And then we looked at how many houses were actually going to come out in the coming year, and we don't exactly know, but it could be between 100 and 170,000. Either way, there's an oversupply. Now, I know that we probably all knew that, but I wanted to present that to you in actual data. There could be, on those figures, an oversupply, in my opinion, of between, and this is broad, 20 and 90,000 new dwellings next year. There could be an oversupply. Now, where they're located is going to obviously impact those local markets, and we'll know that as we go forward and we see those vacancies essentially happening. The other thing that may happen, and while it doesn't, I don't have the data here to prove this, but I have got historical data, is that when things get tight, people kind of cram into houses more so. So you might get auntie and uncle come and stay because they sold their house or whatever. So the per person number, the people per house increases. It goes from 2.6, sometimes it hits 3. Now that makes a substantial difference to the amount of stock that's needed in the market. All I'm saying with all this is that the data coming out so far has been fairly rosy for the property market, and I'm not saying it's all doom and gloom. I'm definitely not saying that. What I am saying is you need to be even more careful than normal of where you're buying and what you're buying, because the data is saying that there is going to be a substantial oversupply of property in the market. Without a doubt, coming next year, there will be an oversupply simply because the property market, the property construction didn't stop. A lot of builders kept building through the COVID event. Their pipeline might have dried up now, but they still brought those houses on. We're also seeing an uptick in owner-occupied activity, which is good, but they only fill a certain number of houses. And if we don't have those new births or the net migration coming in, then we're not going to need as many properties going forward. So, what should you be looking for? Well, that's a really good question. Firstly, you need to be looking at the areas that are going to be growing, and we'll talk about that in some upcoming events we've got. We've got the Future of Property events coming up next month. And so in those events, we're going to have a specialist on, and they're going to be talking about the changing styles of properties, the changing property industry, and the changing demographics within that, and all that intertwines. So that's going to be a few events we've got coming up in towards the end of June. So make sure you jump on and hit us up and connect with us so you get updated on that. But what really is going to happen is this. In my opinion, we've got JobKeeper and Jobseeker that is effectively underpinning the property market as it stands right now. We've gone through the Corona event, we've got borders starting to open, except if you're in Queensland, and then they'll open fully and all that sort of stuff. Now, by the end of, or say, not by the end of the year, but say by September, all borders will be open, everything back to normal, as the government says. But, will we go back to normal? You keep hearing about this new normal, and I hate the term new normal because normal is always changing. Our normal in 2019 was not our normal in 2009 or 1999 or, 1919. The normal is always changing. So don't get caught up in the new normal. Just get caught up in what's happening in the market, in your financial situation, how you need to safeguard your personal situation best moving forward. What's going to happen is that JobKeeper and JobSeeker are ending, and I say they're effectively underpinning the market right now because they are. The government has said that's for food and shelter, essentially, and for some minor bill payments. There's mortgage, I call it hiatus, the holidays, interest rate payments, mortgage payments are suspended, and if a lot of people jumped on that in March, that's going to end somewhere around September-ish. JobKeeper and JobSeeker JobSeeker finishes their bonus payment at that time, and JobKeeper ends towards the end of September. So in October coming around, a lot of people are going to have their mortgages to pay again. They're not going to have JobKeeper. They're not going to have the bonus from JobSeeker. And they're potentially, unless some form of miracle happens, all the jobs are back to normal like they were in February. Well, personally, I can't see that happening. What I can see happening is that come October, we're going to start feeling some pain. Coming up to Christmas, people are going to push on through and do the absolute best they can to get through Christmas. And come January, we're going to see some pretty good buying in the property market. You'll see good buying from September, October this year. And it'll sort of culminate in perhaps carnage in that January timeframe. Now, that's just my opinion. And that's just what we do here, right? We look at the data, we interpret it, and we've got to put an opinion on it because you want to know what it's all about. But if that's the case, then there's still some strategies that work. And what if I told you that 2 out of every 3 strategies in property right now are going to fail, but there's some strategies that are going to work, and we need to look at that. So if we go back to our compass, the trusty Zach, the Zenium Action Compass, and we go, okay, well, we believe that we're going to see this oversupply, and then we're going to see some carnage in the market, then the strategy we need to be looking at is discounted buying. Without a doubt, we need to be looking at discounted buying strategies. Now, what does that involve? Well, there's a whole thing we can do on that. We're probably looking to put something together next week on the discounted buying strategy and tell you guys. But the fact is, that's what you should be looking at. Right now, you shouldn't be looking at a capital growth style strategy, because that's going to be a bit crazy, right? Now, we're talking about the next 12 months. We're not talking about the next 10 years. We're talking about the next 12 months. Right now, if we're going to act in this space, you're going to be hitting people up. You're going to be going, grabbing a discount, grabbing a good buy. Someone's needing to sell. Either the bank's going to take it, or you're going to pay them a little bit more, and you get to and you take it. They get some cash that the bank was going to otherwise end up with. So there's some advantages there. But that's the strategy that you need to be looking at, is discounted buying. So it can be including discounted development, developing a discount, things like that. But you know what I'm saying. That's where we're at. So right now, that's the state of play in the markets. We've seen the HCW clock. We're not going to show you any opportunities. We normally do that on a separate session, but I'm not doing that at the moment because firstly, there's opportunities that are going to come. And I've seen some stuff come across my desk already where I've seen a development site that was $1.5 million off. So it's about 25% off already. And I've seen that come across my desk. There was circumstances surrounding that ownership and that deal that they needed to exit, and there was a massive discount on that side. So these are the things that you're going to see coming about. So what do you need to do right now? You need to be ready. You need to be ready, because what happens in the bust time and the carnage time, the time when it's depressed or unknown, is that it creates the next boom, right? Now, I'm not about to say we're about to have a boom. I'm not saying that. What I am saying is you need to be very careful what you do at this time. You need to safeguard your cash, safeguard your wealth, and put yourself in a position to act when the time is right for you. We will keep you updated with what's going on in the markets, and we'll keep you totally across everything that's going on, good and bad, with an unbiased opinion on the news. Because, in my opinion, that comment that the Prime Minister said yesterday about the net migration is a pretty big deal. And that changes our population growth and the need for housing. Coming out the other side, what you can see happens is that if we have that oversupply of property, it will eventually get eaten up. The construction industry will slow right down, and that property will get eaten up in terms of used up, right? Get used. And then if all of a sudden the borders open and net migration increases again, then we could be behind the times. And in 12 months, I could be getting on here and saying, guys, we've seen that net migration was down. Now the floodgates are open again, but the property industry, the property construction industry, has just had to go to sleep. It's been in hibernation because there was a lag time from everything else, because they were already working on projects, and then they stopped working on projects, and now we've opened the floodgates again, and there was a baby boom because we had a recession, depression, and now we've got migration up, and so we need more houses. But the development stopped because no one was doing development in the COVID event time. No one was constructing. And we could be having a very different discussion, middle of next year about what property is. Now, I'm not saying that is the case, because we always watch the data. What I am saying is that we watch the data so our discussions change every month that we do. So keep an eye on that, because that's how the cycle happens. The indicator for the start of the next cycle is always going to be increased rents. Okay? So increased rents. So we are here. This is Phil Anderson's property clock. And we're here in the mid-cycle slowdown right now. These were dated back in 2014. So 2020, mid-cycle slowdown, which is exactly what we're seeing. And then we jump from the internal clock to the external part of the 24-hour part of the clock. And then we start, whenever that is, potentially 21 onwards, potentially. And that 21's a year, remember? It could be December. We see the next part of the market in full swing. And that's because of that lag time I was telling you about. You know, there was no construction happening and there was no new subdivisions and all that. So then there was a massive demand pent up because these things are all in demand. And then, of course, all the government spending and the stimulus and the flooding of cash in the market and all that. So that takes time to work through. That's not a quick thing. But when that happens, then we do infrastructure projects and we get major real estate activity, etc., on to the next major crash time. And this is why we get our up and down cycles, right? Up, down, up, down, up, down, because we all, are lemmings and we all are reactive rather than proactive. And right now, there's no work, no pipeline, so we stop constructing, and therefore it gives us a lack of construction when the wrong time happens in the future. All right, that's pretty much it from me. As I said, if you want to catch up on any of our back catalogues, you need to go to either the Facebook page, which is our Xenium Property, or our Xenium YouTube page. We've got all our back catalogues of the latest interviews and stuff we had. We've got Property for Chicks coming up next Wednesday. They got an awesome guest on for that, so you won't want to miss that. And Rachel and Karen are doing some pretty great things on that show, and we're getting a lot of awesome feedback from the ladies on that show. So thank you all for watching on that one and giving the feedback. I've got some cool guests coming up next week, and we've got another American Monday happening on Tuesday morning where I go through my story and my experiences, which a lot of you don't know, it's turned out, of where I started as investing in the US. And I've got some awesome photos and some things to go through there that you'll have a good chuckle of. I'm not going to say that I look any younger, even though it was 16 years ago, some of those photos. So you need to don't miss that. That's 10 a.m. Tuesday, and so that's 5 p.m. Californian time on Monday. And then we've got PJ back in next week as well for his fortnightly update. So that's it from me today from Xenium Live. I'm Scotty North. Thanks all for watching and listening on our Real Property, Real Wealth podcast. And don't forget to keep hitting us up on Facebook. And I get a lot of private messages too, so thank you very much for that. I appreciate that. And so hit us up for any topics of ideas. This is always a bit of a bland one, I know, when I got to go through the data, but I just always like going through the data for you guys to know, to show you that we are across it and to make sure you're getting the real stuff, not some sort of stupid headlines. All right, I'm Scotty North. This is Xenium Live. Thanks for listening.